So, as Mr. Yeo just mentioned, the theme of our conference is Future-Proof Supervision for Innovative Banking World. And it's my pleasure to introduce our keynote speaker, who has travelled all the way from Spain to share his unique perspective with us today. Please join me in giving a warm welcome to Mr. Pablo Hernández de Cos, Governor of the Bank of Spain and Chair of the Basel Committee on Banking Supervision, to give the keynote speech.
Thank you very much, everyone. Thank you, Eddie. We are very happy that Hong Kong is back. We've realized in the last two days that really this is a marvelous place to come back. So thank you also for the invitation to speak at this joint conference, celebrating, as Eddie was emphasizing, the Hong Kong Monetary Authority's 30th anniversary. But as chair of the Basel Committee, I should mention at least two more anniversaries that are worth commemorating today. First, the Basel Committee has met in person in Hong Kong over the last couple of days. It's been 10 years since the committee last met in Hong Kong. And I think I can speak on behalf of all members of the Basel Committee in saying that it is a real pleasure to be back here, and I thank the Hong Kong Monetary Authority for its hospitality this week, and let me mention in particular Arthur and all the colleagues that were organizing this meeting. Second, it's been also 14 years since Hong Kong Monetary Authority joined the committee as a member. Since 2009, the Hong Kong Monetary Authority has always been a highly valued member, not least for its long-standing commitment for cross-border cooperation and its constructive contributions, including, by the way, chairing some of the key committee groups. The committee clearly has benefited in many ways from the Hong Kong Monetary Authority's perspective and experience across a wide range of issues during this period, and I'm pretty sure that it will continue to do so in the future. But let me come back to the 30th anniversary milestone and revisit the work of the committee in the year of the Hong Kong Monetary Authority's establishment. In 1993, the Basel Committee had only recently finalized Basel I, the Basel I framework, and was issuing consultation papers on the prudential treatment for capitalizing against market risk, but also measuring interest rate risk. In some respect, certain elements of this consultation sowed the seeds for the development of the Basel II framework later in the 90s, yet, despite the passing of 30 years, some of the committee's supervisory concerns in 1993 sound familiar. Going back to the consultation papers issued at that time, the committee noted that market risk to banks were growing as a result of, and I'm quoting, the rapid development of financial markets. It went on to stress that interest rate risk is a significant risk which banks and their supervisors need to monitor carefully. I'm still quoting. And that a change in interest rates might adversely affect a bank's financial condition through its effect on all interest rate-related assets, liabilities, and off-balance sheet items. I'm still quoting. So I guess it's obvious to everyone in this room that these messages continue to hold today, as we've seen from recent events, from very recent events. Indeed, these recent events have further highlighted the importance of a resilient global banking system underpinned by effective bank governance and risk management practices, robust regulatory standards, and a strong supervision supported by proactive cross-border cooperation. Since the great financial crisis, the Basel III reforms have helped the global banking system absorb different shocks and continue to lend to credit-worthy households and businesses. But The risk of high inflation, Eddie was also mentioning this, lower growth and geopolitical tensions are posing risk management challenges to banks. Years of unprecedentedly low interest rates underpin the build-up of leverage across households and corporate sectors. As central banks raise interest rates to combat inflation, borrowers are now facing sharply rising debt service burdens, and a broad-based repricing in asset markets could expose banks to additional risk and new risk management challenges. So I guess it's obvious to everybody that the banks and supervisors must be vigilant to the evolving outlook to ensure that the global banking system is resilient. And in this regard, the Basel Committee will continue to closely monitor banks and market developments and to assess the financial stability risk of higher interest rates to the global banking system in particular. In addition, I should also announce that we have agreed, it was published yesterday in the press release after our meeting here in Hong Kong, we have agreed to take stock of the regulatory and supervisory implications stemming from recent events with a view to learn lessons from the recent events. So with this introduction, let me now focus the rest of my remarks on one particular area, which has witnessed profound transformations, namely the use of macroprudential regulation and supervision. As at its most basic, macroprudential regulation and supervision seeks to safeguard financial stability by applying primarily prudential measures through a system-wide, and that's the key, system-wide perspective on the distribution and evolution of risk across at least two main dimensions. The first dimension is the cross-sectional distribution of risk stemming from interconnections, common exposures, and collective behavioral responses by financial institutions at any given point in time. And the second dimension is, of course, the temporal dimension, the evolution and amplification of risk at an aggregate level over time, resulting from the inherent procyclical dynamics of financial institutions and markets through the financial cycle. Economic historians may note that macroprudential policy is not a post-global financial crisis innovation. Peter Cook, one of my esteemed predecessors as chair of the committee, first mentioned the term at a committee meeting in June 1979, where he noted that the committee had a justifiable concern with macroprudential problems, and it was the link between those and macroeconomic ones which form the boundary of the committee's interest. The BIS then used the term publicly in a report in 1986, where it defined it as a policy that promotes the safety and soundness of the broad financial system and payment mechanisms. But the pre-global financial crisis macroprudential world was not just limited to conceptual issues, conceptual discussions. Many jurisdictions, including, by the way, several in the Asia-Pacific region, had in effect applied macroprudential measures years before the global financial crisis. For example, Hong Kong applied bank exposure limits to the property market as far as 1994. Malaysia increased risk weights for certain housing loans in 2005. India increased provisioning requirements in the same year. So macroprudential policy is, in many ways, an old idea whose time has come around again. However, the global financial crisis also painfully highlighted the systematic use of macroprudential regulation and supervision. Fueled by very high levels of leverage and maturity transformation, a web of opaque and highly interconnected chains between financial entities was left largely untouched by regulation in the run-up to the crisis. As risk started to crystallize, the sharp retrenchment of key financial services by banks and other financial entities, in part, of course, a necessary process to unwind the excessive leverage in the system, exacerbated economic conditions and hindered the subsequent recovery. Therefore, a fundamental revamp of regulation and supervision was needed. Thankfully, the global financial crisis did not go to waste. as it prompted a breakthrough in the use and application of the macroprudential perspective. Jurisdictions around the world adopted financial stability mandates, deploying an increasing number of macroprudential measures over time. The committee itself was quick in applying a more rigorous macroprudential regulatory and supervisory overlay post-global financial crisis. It set up a high-level macroprudential supervision group to develop approaches to promote the practical implementation of macroprudential supervision to the banking sector, with the committee's broad work on macroprudential issues comprising at least three main dimensions. First one, the introduction of regulatory capital and liquidity buffers. These buffers provide an additional layer of shock-absorbing capacity over and above minimum requirements. They are intended to be used by banks in times of stress to absorb losses and meet liquidity demands in an orderly way, while continuing to lend to credit-worthy households and corporates. They include, of course, the capital conservation buffer, buffers for globally systemically important banks and domestic systemically important banks, a counter-cyclical capital buffer, and a buffer of high-quality liquid assets. Second dimension, the development of a suite of regulatory and supervisory metrics. In addition to the risk-weighted ratio, the Basel III framework also includes a leverage ratio, large exposure limits, and two liquidity standards, the LCR and the net stable funding ratio. And supervisory stress testing plays an increasingly important role across a number of jurisdictions. The move towards a multiple metrics framework recognizes that each individual regulatory supervisory measure has strengths but also weaknesses and cannot be relied on in isolation. The multiple metrics framework is more robust to arbitrage and erosion over time as each measure offsets the shortcomings and adverse incentives of the others. And the design of the Basel III framework was in itself precisely based on a system-wide perspective on these metrics. And the third dimension is, of course, that the committee now pursues a more rigorous and forward-looking approach to its supervisory initiatives. This includes our regular exchange of views of emerging risks and vulnerabilities and our ongoing work in promoting a strong supervision through the issuance of guidelines, sound practices, and supervisory initiatives. And we approach this work through both a macro but, of course, also a micro-prudential lens. So, what has been our experience to date with regard to the macroprudential elements of Basel III? The committee has been evaluating the impact and efficacy of these reforms, drawing on a wide range of empirical evidence and consulting with external stakeholders. So we have published already three reports to date, and I could not do them justice in a single speech, but let me at least highlight a few high-level takeaways. The overarching story is a generally encouraging one, but also an incomplete one. Starting with the impact of Basel III macroprudential reforms on banks' resilience, the committee found that the introduction of these reforms was associated with a decline in various measures of systemic risk. Starting with the G-SIB framework, we found that G-SIBs reduced the share of complex and high-risk assets of their balance sheets in response to their G-SIB designation by a greater proportion relative to non-G-SIBs. They also issued more capital than non-G-SIBs, and importantly, this behavior did not come at the cost of a significant negative change in their lending behavior. More broadly, our evaluation found that banks' capital strength can help dampen negative feedback effects among banks under stress, thereby reducing the probability of a stress resulting from the failure or distress of a single bank. And of course, such outcomes are fully aligned with the objectives of the G-SIB framework from the very beginning. The experience with the countercyclical capital buffer as a time-varying macroprudential tool has also been broadly positive. First, the buffer has been deployed by several of our members. Prior to the COVID pandemic, 8 out of 27 committee member jurisdictions, including, by the way, Hong Kong, which was one of the first, had activated or announced an intention to activate the buffer. 7 of these jurisdictions subsequently released the buffer in response to the pandemic, consistent with a broader loosening in macroprudential policy more generally, and 5 of them have since reactivated or announced their intention to reactivate the buffer in response to an increase in cyclical systemic risk, with an additional member recently activating the buffer for the first time as well. Equally important, the empirical analysis that was performed by the committee finds evidence that during the pandemic, capital releases had a positive additional effect on lending. Banks that benefited from capital relief during the pandemic tended to see a stronger loan growth than other banks. So given our experience so far, the question that we can ask is, what is the outlook for the Basel III macroprudential tools? If the past decade placed macroprudential policy firmly back on the map of central banks and supervisors, the decade ahead will, in my view, ideally see it being deployed as part of a holistic macrofinancial stability framework, one that considers jointly monetary policy, fiscal policy, and macroprudential policies with the objective mainly to stabilize the economy. To help reach that goal, let me outline at least three open questions that I believe warrant further reflection. The first question relates to the role and design of the countercyclical capital buffer. In short, the question is there a need to further specify or define or refine the intended objectives, calibration, and mechanics of the regime? Or is there virtue in providing sufficient leeway and flexibility for jurisdictions to adapt the framework in a manner that reflects domestic considerations? As currently designed, the countercyclical capital buffer's primary objective is to build resilience over the credit cycle. The committee's guidance notes that the buffer seeks to ensure that the banking sector in aggregate has the capital on hand to help maintain the flow of credit in the economy without its solvency being questioned when the broader financial system experiences a stress after a period of excess credit growth. The committee also recognizes that there might be a positive side benefit of the buffer insofar as it helps lean against the build-up phase of the credit cycle, but that this was not a formal objective of the committee. Yet, in practice, buffer releases by our member states to date have been due either to the pandemic or to political economy events, and not in response to downturns emanating for credit full booms. True, such releases were arguably still consistent with the ultimate system-wide macrofinancial resilience objective, but they also underline the buffer's potentially broader scope and remit. Is there a need, therefore, to further assess the reasons for the counter-cyclical capital buffer and its magnitude during the build-up phase? More broadly, where does the buffer sit alongside other time-varying macro-prudential measures such as stress testing or more targeted policy measures such as those that many jurisdictions have used to dampen excessive growth in their housing markets? Related to the above, we have also seen a range of practices when it comes to deciding on the appropriate buffer rate. An increasing number of jurisdictions have chosen to implement the so-called positive cyclical neutral buffer rates. Put simply, the countercyclical capital buffer is set as, at a positive rate when risks are judged to be neither subdued nor elevated. Such an approach can help further bolster banking system resilience by ensuring that there are sufficient releasable buffers in the event of sudden shocks. And this is precisely why the committee issued a newsletter last year recognizing such benefits and supporting the ability of authorities to set a positive neutral CCYB on a voluntary basis. My second question relates to whether additional global macroprudential measures are needed. For example, the committee also recently issued guiding principles for the operationalization of a sectoral countercyclical capital buffer, which could allow for a more targeted macroprudential tool in response to the build-up of risk in a specific sector. But the question is, should we build on this framework and consider other macroprudential tools? And two examples spring to mind. First, Could more be done when it comes to cross-sectional macroprudential dimension of the Basel III framework and non-bank financial intermediation, an issue that was also raised by Eddie in the introduction? While the focus of the committee is on the global banking system, we know that the growth in non-bank financial intermediation is of great importance given the interconnection between banks and NBFIs. Banks' cross-border claims on NBFIs grew by almost 40% during 2016 and 2019. In aggregate, banks' funding from and exposures to NBFI account for almost 8% and 5% respectively of the total assets, although this masks considerable divergence across jurisdictions. And events over the past 3 years, including the market turmoil in March 2020, idiosyncratic episodes of NBFI distress, and margin dynamics have highlighted how these channels of interconnections can pose risk to banks. So against this backdrop, the committee relies on various tools and measures to mitigate system-wide NBFI risk to the global banking system. First, the calculation of banks' G-SIB scores is in part based on banks' intra-financial system assets and liabilities. Second, the committee's post-global financial crisis reforms include a range of regulatory measures related to banks' exposures to NBFI, including with regard to banks' exposures to central counterparties, securitizations, equity investments in funds, and margin requirements for non-centrally cleared derivatives. Third, the committee has also issued supervisory guidelines on the identification and management of a stepping risk resulting from potential financial distress in shadow banking entities spilling over to banks. And finally, more recently, the committee published a supervisory newsletter in which it underlined the importance of reviewing and enforcing existing guidelines and standards with regards to banks' NBFI risk management practices, due diligence, and disclosures. And we also plan to develop additional guidance with regard to NBFI risk management over the course of this year. So while great progress has been made in shoring up banks' resilience with regard to NBFI entities, the question is whether this is sufficient. To date, virtually every episode of NBFI distress has involved banks, either as a direct counterpart or through indirect channels. To the extent that NBFI continues to grow in systemic importance, is therefore a need for additional bank macroprudential measures aimed at mitigating risk to the banking system from interconnections with NBFIs? It is not possible to provide a definite answer at this stage, given ongoing initiatives, but I believe that we should at least keep this question open. A second set of macroprudential measures that could potentially benefit for further global work relates to targeted measures such as loan-to-value and debt-to-income type limits. These have historically been the macroprudential measures most used by jurisdictions. About 300 such measures were applied between 1995 and 2018. This is perhaps not surprising, as the empirical literature suggests that such limits may help curb housing credit growth, so they are very useful in this respect. While these homegrown measures have generally worked well and committee members have been sharing approaches and experiences, the question is whether benefits could accrue from a common set of global principles for designing and operationalizing such measures. And finally, my third and last question is about an issue that has already received much attention, namely the usability of Basel III buffers. The question is, to what extent are these buffers usable in the way in which they were intended when designed? Of course, now I won't provide a detailed account of the various arguments that have been put forward, arguing in favor of changes to the framework or maintaining the status quo, but at least let me make a few more general points. First point, well, I guess it's obvious to everyone that no matter how the framework of regulatory buffers is designed, a few things remain true. You can't use what you don't have, would be the first one. That means supervisors will need to ensure the appropriate build-up of buffers during good times. There needs to be a will to take action, which, to be frank, we all know will usually be unpopular, will always be unpopular. And second, whether or not the true impediments to drawing down buffers comes from supervisors, market participants, or banks themselves, the question is, to what extent could this simply reflect a discomfort about going below a certain level of resilience? To put it another way, a buffer is only truly a buffer if, after it is completely used up, this remains no questions as to the bank's strength. Or in other words, the usability of buffers clearly depends in some respect on where you land in terms of a post-buffer use capital ratio. So I guess there is no single answer to these questions, but I believe that we would be advancing the cause of global financial stability by further reflecting upon them over the coming years. So let me now try to conclude. First idea that I wanted to stress is that good progress has been made by the committee over the past decade in adding a macroprudential overlay to the Basel framework. We have already seen the benefits of these measures with regard to safeguarding the resilience of the global banking system and its ability to absorb system-wide shocks. But, second message, there are also a number of important questions and issues that warrant further reflection, especially as part, in my view, of a holistic macro-financial stability framework. By its nature, however, any macroprudential regime builds on and complements the underlying microprudential regime. Whether we look at the past 30 years or more recently, there have been no shortages of episodes that have highlighted the importance of having a robust macroprudential regulatory and supervisory regime, including with regard to fundamentals such as liquidity and interest rate risk management and interconnections with NBFI entities. So as we advance our thinking and work on macroprudential policy, we should also continue to ensure the macroprudential base is robust. As the committee comprises both central banks and supervisory authorities, and through its global membership and extensive outreach program, I'm convinced the committee is well placed as a forum to help drive through this work and foster ongoing cooperation. Thank you very much for your attention.